Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Aviso Wealth. For more details or to send in your questions, check out the show notes at treybino.ca/podcast. And if you want to learn more about me, start with episodes 1 and 2.
So close to a perfect intro,
but so far. So this episode is about setting up systems in advance specifically for charitable giving, because you know that about yourself, so you want to be in a good spot when that time comes. And this is lovely. She's slowly nodding to me like, okay, this is gonna be fun. So as I've mentioned before, as you start to build wealth and start to increase your income, etc., there is a looming hand on your finances, and that's the tax man.
Yeah.
And that comes into play when you start to do other things that the government wants to incentivize its citizens to do. So the one that we're going to talk about here is giving to charity. It is good for a country, for its citizens, to create and give to charities. Charities are fundamentally not-for-profit institutions, and if every single operating entity or whatever in the country was solely there to earn a profit, it means that a lot of the fabric would fall apart, because you'd have nobody trying to help hospitals, right, and giving back to hospitals to buy new equipment. You'd have nobody, libraries would be gone. There's so many different areas of for me, I'd like to support financial literacy stuff, right? So I'm the chair of the pro bono committee for the Financial Planning Association for Canada. And part of the reason I wanted to do that was it's like a give back, right? I help with the foundation's learning literacy to help teach financial literacy. I'm on the board there. Again, I wanted to do that. Part of my story was underprivileged individual learns a lot about finance enough to then turn that into action and create wealth, right? So I wanted to give back, find ways that you can kind of do that for other people. That's charity.
Yeah.
So this specifically, though, is about how to give to charity in an efficient way. So when you think of giving to charity, what's the first thing that comes to your mind?
Giving to charity would be like donate. To be honest, the first thing that's coming to my mind is that we were fostering dogs and we adopted Sika. I'm like, that's my, I'm like, I'm thinking about all the rescues and there wasn't all the
puppies.
Dogs. Yeah.
Okay, so there's the giving your time is a big thing, right? Yeah. There's also giving money.
Yes, obviously, yeah, donations,
yeah. Right?
Yeah. And I do know, because we have donated to charities before, and I know that you get a charity, receipt.
Yeah. Right. So yes, you do. If you give to charity, so you can give cash, though. You can give in-kind donations. So if you give a service to a charity, then there's a way that the government lets you assign a value to that as like a business. So there's that. There is what we're going to talk about is giving securities.
Ah, yes.
So I don't know if we've done that. We had to fill out paperwork and stuff for that. I just kind of make you sign here and you just sign it. But that's the way that we give if we're going to give any large amounts. That's how we do it, and we'll talk about why. But they're the main ways. And what you'll find is that when you're looking at how to give to charity, there are 3 parties in that relationship. There is you, the giver, there's the charity, who's the receiver, and then there's the CRA, the tax man. And these activities are incentivized, so the government provides incentives for you to do that. but the incentives are not equal. Some are better incentivized than others. And one of the best ways that the average Joe person like you and I can be more tax efficient with our money and give more to charity and kind of cut the CRA out of it a little bit is to give securities that have gone up in value. Okay, so the way it works is if you was to, let's say you was to give $1,000 to a charity, you go out to work and let's say you're in a 40% tax bracket. To get that $1,000, you go earn $1,000. Government then takes 40%, and so $400. You then go take $600, give that to charity. You then get a tax credit, a small tax credit. Let's say your all-in cost is $700. $300 of that $1,000 goes to the charity. So $300 out of that $1,000 goes to the tax man. At the end of the day, you get a little bit of a tax credit. Government ends up with $300.
So wait, if you gave $600 to charity,
yeah, you went and earned $1,000.
Yes.
You get taxed 40%.
Yeah.
Government takes
so
$400.
So then you're like, I'm gonna go give this $600 to the dog rescue.
Yep.
And when the dog rescue receives that money, it gets taxed again?
No, you get a tax credit as a person that gave to charity. No, charities don't pay tax.
Okay.
So no, you get a tax credit. So
Yes.
the government allows you to then deduct some tax. So they give you, I'm going to say $100 back.
Okay.
Right? So the government at the end of the day has $300 of your money.
Why do they have $300? That's where I'm lost. Sorry.
So you go out and you earn $1,000.
Oh, sorry, from the $400 because they're giving you the tax credit back.
Yes.
So, okay, sorry. I thought you were saying. Sorry, it has been a long day for me. So I thought you were saying the $300 was like out of the $600. It doesn't matter. That's not what you're saying. I was like, that's crazy, but that's not what you're saying.
No. I'm bringing something up so I can. That was butchered completely.
By me? Or?
I think by both of us. Okay, so on a typical gift to charity, you as a person will go out and you'll earn $1,000, and the government will take their cut. So let's assume it's 40%. So they'll take $400. You'll be left over. You'll have $600 left over. You'll then take that $600, give that to the charity, and the government then gives you a little tax credit, charitable tax credit for that, and you end up basically getting back $100 from the government. So at the end of the day, of that $1,000, government has $300 of it. You have $100 of it. Charity has $600.
Mm-hmm.
Okay, and that's the way a typical gift to charity would work if you was using cash. But there is a better way, and the way that you do that is by giving securities that have gone up in value that are in non-registered accounts that you would otherwise have to pay tax on.
Yeah.
Okay. CanadaHelps. So CanadaHelps is an organization that processes payments for charity. Okay.
Yep.
So they have a cool little, which I'll leave the link in the description. But they have a cool little comparison where it shows the difference between, for a security, paying the tax, like selling the security, paying the tax on it, giving the rest to charity, versus giving that security directly to charity. So this is no longer you giving cash. This is you giving 10 units of this mutual fund or 15 Apple shares or whatever it is. And then the charity gets it and sells it.
Yep.
So here we have, so if you were to sell it, so original cost of securities is $1,000. So the current market value is $5,000. So typically there'd be a capital gain on that. So you'd then pay tax on that $4,000.
Mm-hmm.
So in this scenario, that total tax is $920, which means that you can give them a donation of that original $5,000. $4,080 is the amount that you can now donate to the charity because you have to pay that tax.
Yeah.
And then your charitable tax credit is $1,876 because that's just what the tax credit that I talked about that the government gives you.
Mhm.
Compare that to you not having to sell it, so you don't have to pay that tax, that capital gains. So same thing, $1,000 original cost, $5,000 current market value, capital gain of $4,000, but you're giving the security, so you don't pay it. It doesn't get realized, which means the donation amount is $5,000. So the full $5,000 now goes to the charity. And because you were giving $5,000, the charitable tax credit is based on that $5,000. So you get a $2,300
Tax credit.
tax credit,
Wow.
and you don't have to pay the tax, right? So it almost ends up that the charity gets to keep more.
Yeah.
It's a
Win-win.
no-brainer.
Yeah.
Win-win. Win-win lose for
The government. But they made the rules, so they're like,
yeah, they want you to do this. It is incentivizing you to give to charity through these means. And this is very useful when it comes to planning for an estate, for instance. So let's say I have $1 million in a non-registered account and I know that I want to give money to charity. Well, I'm not going to name the charity on my RRSP, right? Like there's things that you can do in order to, sorry, you're looking at me confused.
yeah, you're not going to name the charity on the RSP is where I'm like confused.
Oh, because the money would be, yeah, I guess I just introduced an entirely new concept. Because depending on how the RSPs are handled at death, there are just better ways to do it. It'd be better that you either name it in an insurance policy, or in a non-registered account, in your will, you would give these securities to the charity.
So basically what you would do is if you're planning for your estate, you have you're writing your will or getting it ready. And you have that $1 million and you're like, I know I want this $1 million in a non-registered account to go to the dog rescue. I'm just going to keep using that. So you would just write that in the will, essentially?
Yes, there are complexities around that when it comes to deemed disposition and how that has to be accounted for. But yes, in essence.
In essence. Okay,
in
so
essence,
you I guess what I'm and maybe this isn't important. Maybe people could just like go to their advisor or whatever to do this. But how would you give the securities to the charity?
So it's very simple. Like CanadaHelps is a way that you would do that.
Okay,
for instance, you just go to a company that's a middleman. If that organization doesn't have the ability to do it, then CanadaHelps works with a lot of charities in Canada.
Yeah.
Or you can go, if the charities are big enough, you can go directly to the charity. And it's very simply a transfer form.
Wow.
It's
just
super simple.
Move this into someone else's name, basically.
Yeah, this is actually a sign that I teach accountants to look for, to know if their advisor, if they're dealing with a financial advisor that doesn't really know what they're doing, versus somebody that is looking at it holistically, is if that person comes in and they have capital gains and things like that they've realized in that year, and charitable gifts that, like large charitable contributions that individual just wrote checks for or like cash for, that's a red sign.
Flag.
That's a red flag. That's a sign that proper tax planning isn't being done. And like, for example, what I do for clients is like giving to church or something like that is a huge one, where if you're tithing, if you're giving 10% of your income, that adds up really quickly over the course of a year. But I would have those clients that tithe build up a non-registered account for the future, knowing that, okay, this can be gifted at the beginning of the year as a security instead of me giving them cash. So for instance, if I know I'm going to be giving a charity $30,000 this year, I'm going to be tithing that to my church, then at the beginning of the year, I can transfer those securities worth $30,000, and then I can take the money that I'm earning and then put that back into the portfolio or whatever, right? So it just helps the overall tax picture if I am giving securities that have went up in value over anything else. And in fact, because I knew that we would be giving to charity, I started an unregistered account before I even maximized our TFSAs. And part of that was I knew that I would be able to maximize my TFSAs if I kept on the route that we was going. And the value of me being able to give it to charity in the future, when I looked at the numbers, it just made more sense because it was a relatively short period of time that my TFSAs wouldn't be maxed. So, but it meant that, I mean, now if we give securities to charity, we get to give securities that have went up 3 times their value. And that's all tax that I just don't have to pay, more for the charity, right? It doesn't have to be complicated. You can keep it pretty simple. But yeah, for people that we know, for clients that I know are going to be gifting an amounts, I leave capital gains there for them to do that with. Because if that's how we get rid of the capital gains and we can avoid that tax on that situation, great, everybody wins.
Yeah, for sure.
So a really, really good way to give to charity is through securities. And I would recommend if you are in a situation, especially, and I mentioned tithing because tithing is the big one. Tithing is such a large amount typically that planning around that efficiently is really important. So tithing actually comes from like ancient Israel, and they would leave like 10% of their crops, and they would give that to God. And the interesting thing is, at that time, that was kind of the tax. It was the priesthood, was like the Levites. That was the tax to that tribe of Israel, because they were the holy tribe. Basically, they ran the temple and everything like that. But there was no other taxes until the Romans came along. But now a lot of churches still follow that practice. But then you're thinking, okay, so you have the Canada tax, then you have the tithe, and let's say you're being taxed at 40%, then you have the tithe of like 10% if that's what you're doing. Now suddenly you're at 50% of your income gone. It's a good idea to structure your finances, if you can afford to do so, structure your finances in a way that can at least bring that down to 45%. You know, like it's good practice to be as efficient as possible.
Yeah.
This is one way to do it.
Makes sense.
Yeah, but it requires a little bit of planning ahead. And even better, if you could do it even better, appreciated securities in like corporations. Perfect. Give them away. Give them away. Get rid of them. That's one that I wish more people did. So let's say you're a professional and you're paid into a holding company or whatever, and you have a corporation and you have an investment portfolio within that corporation. Use that corporation to give your gifts and stuff to charity. There's no need for you to do it personally. You're doing it pre-tax. It's the most efficient way for you to do it.
So it's basically just from, like, the form would be like from corporation A transfer to charity.
Yeah. And if you're doing it personal, it would be from person to charity. Same form.
But you're getting taxed personally versus the corporation wouldn't be taxed yet, right? Is that what you're saying?
Yeah, but again, this is muddying an entirely new concept for financial planning. But yes, so like quick rundown on corporations is there are 2 layers of tax in Canada. There's the first layer is when a corporation earns money. And then the second layer is when you have money to spend personally. And again, talking about the government wanting to incentivize certain things, the government will treat money that has only been taxed by that first layer differently. There's an entirely different set of tax laws regarding that money versus money that has had both layers of tax. So that's why it's sitting in your or my personal checking account for me to go spend on a trip to Hawaii, right? So there's layers of tax, and depending on where money is in that layer depends on how the government treats it. But as a general principle, yes, money that is sitting in that first layer, so just being taxed that first layer of tax, if it's sitting in a portfolio which is, again, a whole other topic, but it probably should be growing, then you can take that money, that first layer of tax money, and give that to charities instead of you personally.
Yeah.
So the effect is that the charity gets more money. It's as simple as that. You pay less tax, you have more in your pocket, charity has more in their pocket, CRA gets cut out a little bit of the equation. Yeah. And they incentivize it. There's a reason that this is not exploiting a loophole or anything. It's the simple fact is that the country would be a significantly worse country if there wasn't charity, if there wasn't, people weren't willing to be generous. And this is just a way to work within their
community. Basically build the community more.
Exactly. And do it in a tax efficient manner. So that's what you should be doing. But yeah, that's the core concept. And the way that you would systematize it is pretty much what we do. It's the same principle that I've already shared, is that you spend what you need to spend and everything else goes towards increasing your net worth. But if you know that you're going to be giving to charity, where you put that money that is increasing your net worth is a little bit different. Mm-hmm. So whereas before you might have purely focused on maximizing your RSPs and your TFSAs, well, in this case, if the numbers make sense, you might choose to also, earlier than maybe you have to, start a non-registered account for the long term with just, cheap index funds, prioritizing ones that have capital gains and things like that.
That are going to grow.
That are good. Yeah. Compared to like GICs and stuff, you can't. I don't even know if you can gift a GIC to a charity. Maybe you can, but I've never come across doing it. I don't know why you would do it. But yeah, typically you're gifting equity type investments that have went up in value to charities. Yeah. So, but yeah, you literally just plan it ahead of time. But this is where we talk about it all the time, where it's half of the battle with financial planning is just knowing yourself. And just because numbers say one thing, if you know something about yourself, if you know you're going to be giving to charity, then you plan a little bit around that. And maybe it's not perfect on paper if you didn't give to charity, but you do. Therefore, there's this little change that would be different from the majority of other people, right?
Yeah.
But that's one. So categorically, if you tithe and you have a higher income, enough to like be maxing out TFSAs and things like that, this is something that should be on your radar. And if it's not, and your advisor has never brought it up, you might not have an advisor, you might just have a salesperson, but it is a big enough deal that I would say it's a big oopsie if you're giving $10,000, $20,000, $30,000 to charity, and they have not brought this up. That's a big red flag for me.
Yeah.
Big red flag. So.
Yep, makes sense.
Yeah. Okay, this is a kind of a short one, I guess. So that's that's how you'd systematize it. But anyway, if you have any questions or anything, obviously feel free to reach out and take a look. CanadaHelps.org is the name of their charity.
Name of the charity or like the processing?
The processing company, not charity. Name of the processing company that does it. And they, just like if you gave with a credit card, they also
do that.
Take a percent. Yeah, they do that, but they take like a percentage, just like any other middleman for payment processing. Also does the same thing, but yeah.
Right.
Anyway, I think it's everything. So the next one is, I was like, let's just stop it there.
Yeah, I was like, I think we're supposed to say something next.
The next one is on RSPs. And so this is another account-specific one. So where we talk about RSPs, what they actually are, how they work, and how you should think about them at different levels of wealth, because their use is a little bit different. So we'll look at that.
Awesome.
Perfect.
See you in the next one. Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.